Following 4 straight winning months for the S&P 500, all 3 major averages closed higher again in August, with the Dow Jones Industrials posting a record high on the last day of the month. As we enter one of the most volatile months of the year, investors will be looking to see if all 3 will continue their winning streak or if the historical volatility of September will just be too much to handle. That action starts now. Solid U.S. earnings and strong economic reports allowed equity markets to cap off another strong monthly performance, with the S&P 500 closing up 3.7%, the Dow Jones Industrials 3.01%, and the Nasdaq Composite up 3.02%. The news of the past 3 weeks has been positive, but the market is priced as though a soft landing, aggressive Fed rate cuts, and extraordinary earnings growth are guaranteed. They are not guaranteed, and the totality of the actual news isn't as good as the equity markets would imply. It's important to keep that context, because if the market is forced to realize that, like the July jobs report forced it to do back in early August, then another 5% air pocket in the S&P 500 shouldn't be a surprise. It is also important to note that since 1950, the S&P 500 has only finished higher in September 43% of the time. So, economic reports such as the jobs report and payroll will be critical at the first of the month for the rally to push through the end of the month. Strong economic data and a continued decline in inflation also pushed all bond yields lower this month. The 5-year closed at 3.71% and the 10-year at 3.91% and the 30-year at 4.19%. Markets continue to price in at least a 25 basis point cut in September. More importantly, the 10-2s yield spread uninverted for the first time in 2 years. Historically speaking, uninversions after lengthy 10-2s inversions have been a negative signal for stocks. Now, while market history doesn't necessarily repeat itself, it often rhymes. And amidst this loud chorus of optimism, I want everyone to be aware of this historical precedence, which really is not good for stocks. Notable events coming up this month are August ISM manufacturing, service PMI, the jobs report, JOLTS, ADP employment, and jobless claims this Thursday. Any material negative changes in the labor reports could definitely reignite fears of a hard landing. As we enter what is known as one of the most volatile and worst performing months of the year, we find great comfort in our model's current allocation of 50% in the money market. During election years, the heightened volatility usually doesn't peak until mid-October. So, our defensive posture will allow us to have time to be patient and see what happens. However, it is common to see a relief rally into year-end after the election has finished. For the month of September, our models continue to hold a 50% allocation to the money market. Our broad focus remains on domestic equities and international equities. Our focus in domestic equities is on large cap growth and large cap blend, with an emphasis on financials, industrials, technology, communication services, and consumer cyclicals. In international equities, our focus is on Europe emerging and Europe developed. As a reminder, my current allocation is not a recommendation. Regardless of what happens next, investors like you need to have a simple and yet solid financial plan that reduces risk, cost, and taxes while securing the necessary income you need to maintain your lifestyle throughout retirement. So, if you don't have a plan, or you're just not comfortable with the plan you currently have, call me today to get pointed in the right direction. I'm Chad Kuntz, and that puts a wrap on the September 2024 Market Action Report. Thanks for joining me. It's time for me to get back to the markets, and that action starts now.